This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Up until now, while dealing with the unincorporated trader, the result of the adjustment of profits and computation and deduction of capital allowances has always been a tax-adjusted trading profit. And then we learned how that profit and when that profit would be assessed in relation to any income tax year. But what we'll now discover is, as a result of the self-same adjustment of profit exercise and computation and deduction of capital allowances, that what we're left with is not in fact a profit, but a tax-adjusted trading loss. Well, if, as they are, HMRC are going to tax us on our profits, then they must give us relief for losses. But of course, these reliefs are prescribed by HMRC. They tell us exactly what reliefs are available, but will then allow us to choose from what is available, what we consider to be best for us. Now, what may be best for us? If you've got a loss, then you're able to set that loss against some figure of income. It might be the trading profit of that business that has generated the loss. It might be your total income that you have made for a tax year. You might be able to carry forward that loss. You would have a choice there of where and how to use that loss. How would you make that choice? Presumably, when you claim a loss relief, you want to get the best use out of it. You want to get some comfort through the tax system, at least, for the loss that sadly your business has sustained. So the issues, as we'll see as we talk through this chapter on losses, that the objectives that the taxpayer will have in mind as to how to get the best use out of losses, and these will be noted later, don't worry about trying to note them down now, but they would be: we know from chapter 2 that taxpayers do not just pay tax at one rate. Depending on how much income they have, what type of income they have, there are differing tax rates that apply. So that therefore means that a taxpayer presumably would like to remove income from chargeability to tax that would be taxed at a higher rate. You'd rather take out income that would have been taxed at 40% than take out income that would be taxed at 20%. You'll get a 40% tax relief, tax back on the use of the loss rather than 20%. And what else would you rather do? I would rather be able to use the loss against taxable income, even if it would have been taxed at just 20%, than against income that wouldn't have been taxed at all, i.e. income that is already covered by your personal allowance. So, we would like to get relief at the highest tax rates available to the individual taxpayer, saving tax at 40% instead of 20%, or any comparative rates higher before lower. We would equally therefore wish to avoid wasting the personal allowance. I would like to use my loss against income that would have otherwise been taxed, whether at 40 or even at 20%. I don't really want to be using my loss against income that wouldn't be taxed at all, because it would be covered by the personal allowance. And of course, there's always a cash flow factor. If I can use my loss sooner, if I could carry it back for use against the income of an earlier tax year, then I've already paid my tax for the earlier year. The use of the loss means I now reduce that income for the previous year, or years as the case may be. In reducing the income, I reduce the tax charge, a tax charge I've already paid, so the impact of that is to give me a repayment. Now, a repayment in cash flow terms is as good as it gets as regards the use of a loss. It is better than merely reducing this year's tax, a tax figure that I have not yet paid over. And each of those, previous year relief, earlier year relief, current year relief, are better than carrying forward to reduce future profits that would be chargeable to tax in a future year. So, when a trading loss is sustained by the taxpayer, by the trader, we have a nil assessment that will go into the relevant income tax computation using the relevant basis of assessment, normally CYB, for an ongoing business. So if for the basis period of a tax year we have a trading loss, the trading profit assessment to include in the income tax computation is nil. We don't ever put a negative. So if you've got a loss, you put nil into your income tax computation or into your working for the best to show the best use of losses. You put in nil. You don't put a bracketed figure. You don't put a negative figure in. It is a nil assessment. And what we must then consider is, what are these options available for the use of the loss? Can I use it this year, earlier year, future year? And what objectives am I striving to achieve to allow me to better decide, out of the options available, which one or ones will I choose? And the loss may be relieved according to the following rules. And as we've said, if you're able to carry back the loss to relieve against income of an earlier tax year for which you have already paid the tax, then this may generate a repayment. In cash flow terms, that's as good as it is going to get. So the reliefs that are available. And it is that idea of looking at a period of time and saying, if I've made a loss that gives me a nil assessment in this tax year, where can I possibly use that loss? I could use it potentially against other income of this tax year. I could go back against income of an earlier tax year, or I could carry forward against income of a future year. So there's your basic three places to go. Stay where you are in the current tax year, go back to an earlier tax year, go forward to a future tax year. Now, knowing the directions in which we can go, we simply now have to know whether we stay in the current year, whether we go back to an earlier year, whether we go forward to a future tax year. Then what do I offset this loss against in any of those years? If we can get those rules sorted, we've cracked it. And loss relief then becomes a very straightforward exercise where most of your answer involves you copying down information for probably 2, if not 3 tax years from the question and just putting it into your answer format, copying down, and then demonstrating which of the losses you're going to choose to use and why. All of that we'll see within this chapter. So what are these options? For any business, any individual here, if they make a loss for an accounting period, one option is to carry forward. And if we carry forward, then you are restricted against future trading profits of the same trade. So carry forward. If you do so, then you go forward against the future trading profits of the same trade. If you want a more immediate relief, then you can have relief in the current tax year and or the preceding tax year. And if you make such a claim, then the relief is against total income. So rather than restricting and just going against trading profits of the future, you can go now against total income of the current and or preceding tax year. Now clearly that's far more generous in terms of the breadth of relief that you're given. You can go against all, you will go against all your total income figure. Now that may indeed sound generous, but it also has a problem. It goes against total income. Total income is before the deduction of your personal allowance. And if you make either of these two claims here, current and or preceding tax year, and it is a truth that will apply to all of these loss reliefs, you can't make partial claims. That if there is a loss available and you choose to use it, be it current year, preceding year, or carry forward to the future, then all of that loss will be used to the extent that there is income available to be relieved. You can't make a partial claim. And here's your problem when you target total income. If the loss is bigger than the total income, then if you make the claim, you will eliminate all of that total income. And that means there will be nothing from which to deduct your personal allowance. And as we know, if you do not use your personal allowance in a year, then for you individually, it is wasted. You may recall there's a capacity to transfer a small part, indeed, of your personal allowance to a spouse or civil partner. But other than that, if you do not use your personal allowance, you don't get to carry it back nor carry it forward. That is wasted. We work on a basic concept with a personal allowance of use it or lose it. So there is a problem. If your losses target total income and they bring that income down below the level of the personal allowance, then the loss is saving you nothing in terms of tax, because that income would not have been taxed anyway, because it would be covered, it would be reduced down to zero by the figure of personal allowance. Another claim possible. You'll see here there's quite a variety. Following a claim in B above, so if you choose to make a claim against total income, be it the current or be it the preceding tax year, if having made that claim, any trading loss still remains. Now remember, if this has happened, you have already paid a price, because in reducing the total income to nil to still have some loss left over, it means by definition you must have wasted your personal allowance. But if you've made the claim for either of these tax years and you still have loss left over, then for the particular tax year for which the claim against total income has been made, then for that tax year you can extend the claim, as it's known, extend the loss claim against the chargeable gains of that tax year. Now we do not as yet know how to calculate our gains of a tax year to know whether this might be advisable, worthwhile, useful or not. But at least it's another option that does exist for us, and we'll see that later. But that claim there in point C here is only available in a tax year where you've already made a claim against total income and you still have loss left over. That means, as we've said, that by definition you've already wasted your personal allowance before you have an opportunity to access this loss relief. We then, in D and E here, have two very specialist loss reliefs. This one in D is opening years loss relief. So very specific to the opening years. Now that is plural. We'll see in the later detailed note upon it that we're able to utilise a loss in this and under this relief if it's sustained in any of the first 4 tax years of assessment. Don't worry about noting that down. It's in your detailed note later. But if you have such a loss in any of those first 4 tax years of trading, then this relief is a set-off again against total income, but this time not just of the preceding tax year, but of the preceding 3 tax years. Now there is an order of that relief and we'll show that in the specialist note. The point is that what we're making here, that if you are a new business and you sustain a loss early on in that new business, you have the opportunity to carry the loss back much further than if you'd been an existing business trading for more than 4 tax years. There you'd only be able to carry back against total income of the preceding year. Here we can carry back against the total income of the preceding 3 tax years. Now if you think about that, that is giving the opportunity to the trader to actually carry back a loss against income that arose potentially in tax years prior even to the commencement of trading. If I start trading in the 16-17 tax year and I make a loss in that 16-17 tax year, I can go back against the income, the total income of the preceding 3 tax years, going back to tax years in which I hadn't indeed even started to trade. So that option is available to you, and of course what it would succeed in doing, given the discussions we've had so far, going back to earlier 3 tax years, as many as the previous 3 tax years, depends how much loss you've got. But in reducing the income of those earlier tax years for which you will already have paid the tax, that would generate immediate repayments. So here again a sensible and a good move from revenue. They are allowing the trader who starts to trade and pretty much straight away sustains losses to get an immediate cash back as regards the use of that loss by going back against total income of the preceding 3 tax years. Now that cash flow, that impetus, giving that loss relief back, the tax paid back to the taxpayer, may give him sufficient cash indeed, maybe to keep that business going. We don't want here to force businesses out of business. If that business could keep going, become profitable, that would tax would be payable on the profits, other people may be employed, creating more income, more tax there to be paid. It grows. VAT is required to be paid on the sales over and above what we're able to recover against inputs. There's a whole stream of tax revenues for the future that may flow from that new business. Let's try, therefore, to keep it going. We're going to give them relief for the loss anyway, if not now, then in the future. So maybe by making this more generous offer, it allows those businesses to keep trading. It's a sensible move on the part of HMRC, and of course is very helpful and very useful for taxpayers in this situation. And finally, we'll come to terminal loss relief. Terminal loss relief there, obviously dealing with cessation of trading. It's a closing years, a specialist closing years relief. Now, as we have just seen, that one relief that a taxpayer always has option to is the carry forward against the future trading profits of the same trade. But if, of course, that trade has come to an end, then there is no carry forward option. Hence, again, what do HMRC allow us to do? If there's no future trading profits against which we can relieve, maybe there's some in the past. And we can go back against the previous 3 years' worth, 3 tax years' worth of trading profits there. The trading profits assessed in the previous 3 tax years. Okay. There, the whole range of different loss reliefs available to us. Let's now deal with each one in turn. The easy one to begin with, the carry forward of the trading loss. Now, we've already stated what would happen with it, would be carried forward and set against the future trading profits, and indeed the first available future trading profits from the same trade. Must be set off in full against the next available trading profit. When it's carried forward, whether you've chosen to do that straight away or it's the only option now left after other options have been exhausted, then it will go against the next available future trading profit of that same trade. You can't get to a future year and say, oh, this trading profit is so small, I don't think I'll bother using my loss against it. Yes, you will. That loss will go against the next available future trading profit of the same trade. Any loss remaining after other, as I've said, other losses have been used, any loss remaining is carried forward until further profits arise. There's no time limit on this. The loss will be carried forward indefinitely. The only time, of course, that loss would lapse is when you cease to trade and there is nowhere else to carry that loss forward to. Now, in terms of how we show our losses, now what we've already said is if you were producing the income tax computation for a tax year and you made a trading loss, so let's just remind ourselves of our basic income tax computation. If you made a trading loss for the basis period for which you are assessing that accounting period, So using CYB, using opening years, using closing years, if your trading income assessment for the tax year, if you've made a loss, then the assessment is nil. Obviously, trading income would be non-savings. You do not put in a bracketed figure. It would be a nil assessment that you include there. If, of course, what you have is this year you have a profit, for example, £40,000, and in an earlier year you had made a trading loss, and some of that loss was still brought forward at the beginning of the accounting period, then you would show less trading loss brought forward. If the loss was bigger than £40,000, then all of that £40,000 would be relieved. So any trading loss brought forward goes against purely trading income. So note how I've set up this computation. I've got my trading income as ever on the top line. I then left a gap of probably 3 or 4 lines before listing the other probably unearned, probably investment income, such as property, interest income, dividend income. So when dealing with losses and you're looking at one or probably indeed more than one tax year, the way to lay that out as you copy the information from the question into your answer, trading income on the top line, if it's a loss, a nil assessment, leave a gap of 3 or 4 lines, and then list out the other amounts chargeable. Again, they're your 3 most likely. Clearly a taxpayer could have employment income, but it's likely, of course, that if you're in self-employment, then you don't have both. It's not impossible, and certainly in a year when maybe you start trading, you move from employment, then for that tax year, there may be a bit of both. Or if you then leave self-employment and go back into employment there, you could have a bit of both. But more often than not, it is your investment sources of income. In they go, and that would bring you down to total income. Right. What we have seen, of course, is that some loss reliefs go against total income, and this again is where loss reliefs may apply, but we'll talk about those in a few moments' time. But if all you're doing is to carry forward a trading loss, it's very simple. It goes directly against your trading income figure. It doesn't go in against total income, such as we have there. When you carry a loss forward, that is where it goes against trading income. So going back to our notes, we've got a little example here. It covers obviously a range of tax years. Year ended 31st of December 14. Now using, of course, here it's a continuing business, a CYB assessment. Year ended 31st of December 14, that ends in the 14-15 tax year. But what you've sustained is a loss. Therefore the assessment is nil. And if what we're doing here, assuming that Albert chose to carry forward the loss, what will it then go against? It will go against future trading profits of the same trade. You've got 3,000 for the year ended December 15, assessed in 15-16. Year to December 16, assessed in 16-17, you've got £10,000. So how would you use that loss of 5,000, irrespective of any other income for the 15-16 or 16-17 tax year? That 5,000 would firstly go against the £3,000, and all of the 3,000 would be eliminated, leaving you left over with £2,000 of loss to then go against the £10,000. Now again, if you have a little look through at the answers to that, you will see how we've laid that out. In fact, I may just have them here. Bear with me for a moment. Oh, wrong chapter. Bear with me, and we'll go back to and see. Very, very straightforward exercise. As we've just seen, for the 3 tax years, 14-15, 15-16, 16-17. Now, I've mentioned it, but didn't actually show it in that previous one, that it would be a good idea when covering more than one tax year, where you have claims against total income, will inevitably mean you are going to be covering more than one tax year. Set up the relevant tax years in columns, such as you see here, with our tax years listed in columns on the right-hand side of your page. We simply had a nil trading income, as we know. In 14-15, it was a loss of 5,000. Not that it was needed here, but in bigger, better, i.e. more difficult questions, it can come in very handy, both for you and for the marker to see what you're doing, is to produce a working headed loss memorandum, where you show what the trading loss was and how it is then used. Carry forward, of course, there to go against the 3,000, that's used. There, trading income nil. You've used 3,000 out of 5,000 equals £2,000 remaining. That then goes forward against the next £10,000 figure, bringing that down to 8,000. And as we said, irrespective of any other income that might exist, those losses will go against the next available trading profits. There are no partial claims allowed. Okay. But far more likely in the exam question is you're going to have one or other of the reliefs that allow as an extension, a set-off rather, against total income. So let's just go back to our notes now. Again, you may get tested on the carry forward, but usually after you have exhausted your claims in either the current tax year and or the preceding tax year. So let's just move on and look at loss relief against total income. Now then, your main reliefs here, a trading loss may be relieved against total income. We know what that now is on our income tax computation, and it is, should you have both, it's unlikely that you would, but it would apply after any qualifying loan interest payments. Now, I haven't mentioned it, I haven't reminded you as yet, but I hope that you remember back in our very first lecture on Chapter 2, we showed the pro forma income tax computation. And it wouldn't be a bad idea if you just go back to your notes there and to the first page of the course notes on Chapter 2 and look at what we showed on that pro forma computation. And we showed how we got total income, and we also showed on that where the two main loss reliefs would apply. The one we've just seen against trading income, and then those that are also most likely to be applied against total income. And total income, if indeed we do go against it, if you had both a loss relief and a qualifying loan interest payment, then the loss relief applies after any qualifying loan interest payment. But that will be a tricky little problem there. So set off against total income of the tax year of the loss and or the preceding tax year. The tax year of loss and or the preceding tax year. So how do we know, therefore, what is the tax year of loss? Simple. By using what we saw in Chapter 6, your bases of assessment. So, for example, if we had, let's have a bit of room here, if we had a loss for the accounting year ended 31st of December 2016, then that, what's happened there? Then that loss for the year ended December 16, there we go, then that loss for the year ended December 16, where could we use it against total income? Right, it says current tax year and or preceding tax year. So tell me, using CYB, year ended December 16, when will that be assessed? It'll be assessed, of course, in the 16-17, the 2016-17 tax year. That, therefore, is the current tax year. So the relief that we've got, trading loss set off against the total income of the tax year of the loss and or the preceding tax year. So what is the preceding tax year to 1617? 1516 is the preceding tax year. So you can quickly and easily, for your loss-making period, determine which is the current tax year and which therefore is the preceding tax year. And if you wish to make the claim, then, as we said, it goes against total income. Again, look back at that pro forma income tax computation at the beginning of Chapter 2. And from total income, you will see a deduction of, it just says, certain loss reliefs. These are two examples of those loss reliefs, setting off your trading loss against the total income of the current tax year, the tax year of loss, and or the preceding tax year. Now, as we know, we calculate the loss for each accounting period, and the accounting period is then assessed using the normal bases of assessment, what you have seen in Chapter 6 there. And all that we're saying is that if you make a loss, then the assessment is nil, and you can then set off against the total income of the current tax year and or the preceding tax year. Another little example, a loss for the year ended 30th of June 16. When will that be assessed? 1617, so we can relieve against the total income of the tax year of loss, using again our current year basis as the basis of assessment. If 1617 is the current year, then as we've just seen, 1516 must by definition be the preceding tax year. If we take the relief against that total income, then there's no partial claims. The loss must be set off to the maximum possible extent, subject to, there is a cap on income tax reliefs. We'll deal with that separately just a little later. Section C below. There's a cap. Not one that is usually going to bother most taxpayers, and only on an irregular basis would probably feature within an examination question. But given again, of course, in Section A, we've got the ability to test the syllabus on a random basis with 15 objective testing questions in that Section A, then anything, of course, could be tested. So there is a cap there, a maximum that could be used. But subject to that cap, we can't decide to say, oh, I'll just use this bit of loss against that bit of income. Now, you know the reason why you might like to do that. If I'd got total income of £20,000 and a loss of more than £20,000, then the only claim I can make is to reduce the £20,000 to nil. But that would mean I'd be wasting my personal allowance of £11,000. I would have liked to have only removed £9,000. I can't do it. If I've got a loss of more than 20 and total income of 20, then the only claim I can make, if I choose to make that claim, is the £20,000. So, no partial claims. Personal allowances, therefore, may be lost. As we know, total income is before the deduction of the personal allowance, and partial claims are not allowed. A claim against total income may be made, as we've seen, for either the tax year of loss or the previous year, or both. The beauty of this was, we said we set off against the tax year of loss and or the preceding tax year. So if you just want to set off against one tax year, that, in honesty and in all honesty, is likely to be the preceding tax year. If you want to do just one, you can do that. Either, as I said, most likely the preceding year or just the current year. If you want to go against both years, you can do so, and you can do so in either order. Current first, then preceding, or preceding first, and then current. You decide the order of claims. So claim against the total may be made either the tax year of loss, the previous year, or both. The 2 years are treated separately, and therefore a claim is required for each such year. Right, now as you'll see, we've then got a little example coming up where it requires us to calculate here our hero Charles, Charles's taxable income, assuming that the trading loss is used in the most beneficial way and trading losses will continue for the next few years. Now, trading losses will continue for the next few years. That means that little benefit is going to be achieved from carrying forward that loss. Certainly no benefit in the short term, as there'll just be more losses sustained. That would therefore encourage us to use losses sooner rather than later. And if you're covering more than one tax year, you don't have to worry about what were the exact personal allowances for those years. We assume that the current personal allowance remains true in all tax years. Now, this example then shows us that we made a profit, and then a whacking great big loss. Also, of course, remembering that total income is involved with current and carryback claims, we need to know what other taxable income the taxpayer had. And Charles, we're told here, had property income in each year of £6,000. Now, what we'll do is work through this exercise together in our next session together. But before we attempt that, I'd like you please to make sure that you go back over the statements that I've made and the little illustrations that I've given to ensure that you are comfortable with the way in which these loss reliefs are to be set. Now again, we're just looking now at the loss relief in the current and or the preceding tax year. Go back. There's not many notes to look at there, but we need to start now to learn these rules so that they stay with us and we can practice. Okay, revise on that, and at the beginning of the next session, again, I will take you through this particular example. So, I look forward to talking to you again then.